Welcome to Relay Chain, a podcast produced by Parity Technologies where we discuss all things Substrate, Polkadot, and Web3. Today on Relay Chain, we have Adam Dossa from Polymath. Adam, can you give a quick introduction to yourself?
Yep. Thank you very much for having me here. So I'm Adam Dossa. I'm the head of blockchain at Polymath. I started at Polymath around early 2018. At Polymath, we're focused on bringing regulated securities to public blockchains.
So, what is Polymath, maybe in a little bit bigger sense than just bringing securities to blockchain?
So our kind of mission at Polymath is to unlock global access to wealth creation through the digital economy. So what that means is that we're sort of a fintech company based on blockchain technology, and we're working on enabling regulated securities, being able to kind of represent and fully manage those securities on public blockchains such as Ethereum and the new purpose-built blockchain that we're working on at the moment called Polymesh. So these securities can be things like equity. They can be things like real estate funds. They can be structured products, debt, commodities. Really any kind of asset that you can think of can be tokenized. I guess why are we doing this? Why do we think this is important? When I look at my background is in the kind of traditional financial world. I spent I think the first sort of 13 or so years of my career working at Morgan Stanley, which is a large US investment bank and trading house. And when I look at financial infrastructure as it exists today, it's usually private, it's usually proprietary, it's heavily siloed by jurisdiction, by country, and so on. And really our vision is that financial infrastructure should be transparent, it should be accessible, it should be more like a kind of public good rather than this sort of siloed private infrastructure. And blockchain technology really represents an opportunity to kind of build that financial infrastructure as a public good and bring all these kind of great things like accessibility, like transparency, obviously reducing costs, and as well as enabling innovation, right? So we've seen over the last 12 months or so, really, maybe 18 months, we've seen this sort of explosion of innovation around open finance and decentralized finance, which I find really exciting. So enabling those types of innovation on regulated products is something we're sort of very excited by at Polymath.
Yeah, so you touched a little bit on what is a security a minute ago. What makes security tokens so transformative? Because I think when most people hear security, they might think of a stock or a mutual fund, which are if you look at it more deeply, that may not be transferable across borders and has certain trading hours. But in a broader sense, beyond just stocks and stuff, what makes security tokens so transformative to the industry?
That's a great question. So security tokens have a few nice properties. One is that they generalize across lots of different asset classes. So you mentioned there a few different things like equity and debt and so on, and commodities. One nice thing about security tokens is they sort of generalize across all those different asset classes. You can think of a security token as being just a way of representing ownership of an asset and it being kind of somewhat abstracted away from that underlying asset. So that's one nice kind of characteristic of them. Another kind of big advantage of security tokens, one of the kind of transformative aspects of them is that it kind of flips. So traditionally with securities, the way it works is that you have some security, it's traded, and then maybe every few months or every 6 months or every 12 months, you have an auditor that comes in that looks at the kind of books and records for that security, tries to make sure, audits whether or not that security has been traded correctly, so has kind of complied with all the relevant regulations and kind of compliance rules that apply to that particular asset in the particular jurisdiction. And that's been the traditional process. And it's, there's some very obvious kind of issues with that, which is that, if there is a problem, if there is some, let's say, fraudulent activity or some kind of illegal activity, it's only after the fact that the auditors kind of come in and notice that, and of course they can then levy fines or take whatever kind of remedial action. So at Polymath, what we're doing is we're building that compliance on chain through things like smart contracts broadly, right? So you have this on chain logic that enforces in real time, at the moment that the trades are actually taking place or the kind of asset management is taking place, we enforce that regulation. So from a regulatory perspective, what that means is that you get First of all, you can kind of audit upfront, so you can check that a particular asset has the right compliance rules attached to it on chain in a kind of fully transparent way, and that those compliance rules are then enforced in real time. So you don't have this kind of after the fact auditing process, and instead you have this sort of real time, effectively auditing and kind of reporting features. So that's one thing which is definitely transformative and should help to. It's one thing that regulators like. Obviously, it should help to reduce malfeasance and these kind of bad activities that we've seen happen in the regulated securities market. So those are some kind of, I guess those are like infrastructure type advantages. I mean, the other types of things which people get excited about with tokenized assets and security tokens is, I mean, it's not a kind of silver bullet for liquidity, but it certainly removes some of the barriers around liquidity. We saw with utility tokens, which were kind of the kind of precursor to security tokens. We saw all this kind of liquidity being unlocked in that space. Certainly, so it's not a silver bullet for liquidity. You still need quality assets. You still need quality investors. You need trading venues and so on. But it removes a lot of the friction around that. So, liquidity is one benefit. And then the other, I guess, exciting thing is that, from a sort of accessibility perspective, lots of these kind of things like these sort of VC funds and real estate funds typically have had quite high barriers to entry. So maybe there might be a minimum investment of $100,000 or something like that, some fairly high barriers to entry in terms of investment levels and so on. With tokenized securities, because the kind of cost and infrastructure scale very nicely, it means rather than needing a minimum investment of say $100,000 because you have all these kind of administrative costs associated with every investment and all the kind of reporting costs, you can bring those levels down significantly, right? And sell much smaller kind of tokenized or fractional ownership
tranches
in assets. Yeah, exactly. Yeah. So that's one. From a kind of like accessibility perspective, that's that's a nice feature.
Yeah, and like a lot of these assets that are inaccessible, like art and other stuff, actually outperforms like the stock market that most people have access to.
Yeah, exactly. And there's, as I said, the kind of the mission statement is this idea of like global access to wealth creation, right? And typically, wealth creation has been a little bit inaccessible, has required, there've been these sort of barriers to entry. Maybe you have to. Kind of understanding products is complex, and there can be a lot of like obfuscation around products and their performance and so on. So putting things on kind of transparent public blockchains helps to also break down some of those barriers.
Yeah. So like, how do you verify the underlying asset? If your underlying asset is purely financial, like a fund, it might be easy. But if you're like tokenizing a house or a painting or something, how do you verify that this thing actually exists?
So that's a great question. Polymath's approach is, so we're a sort of a technology provider, right? So we're not issuing assets ourselves. We're sort of providing the sort of basic technology that allows, sophisticated technology that allows asset issuers to do that. And for sure, in most cases, putting things on a public blockchain doesn't solve this issue of, does the actual underlying asset exist, right? I'm sure there are lots of examples. There's kind of Bernie Madoff type examples, right, where the underlying assets have not really existed in the way that people expected them to in the kind of traditional world. So that those problems don't go away. One thing you can do is you can make sure there's a very clear audit trail around things like documentation, so legal documentation and so on. And you can put that onto the blockchain in some form, either via kind of hashing that data and putting it on the blockchain and kind of tracking that through an audit trail. But it is certainly the case that there's still some kind of off-chain legal due diligence required. One other thing that's it's a little bit forward-looking, right? But one thing that kind of blockchains is quite, I guess, an experimental area in terms of blockchains is representing reputation on chain. So this idea that if you have some asset or some actor or entity that's on chain, you can have a kind of public view of the reputation around that, either that asset or the entity that's issuing that asset, and you can kind of that again becomes more transparent. It's something that potentially lots of people can kind of get involved in, and there's lots of things like token curated registries and these sort of different approaches. So reputation is definitely an emerging area, but it's an interesting area when it comes to, I guess, like almost as an alternative or addition to the traditional approach, which is kind of credit rating agencies, right? So you have obviously these big credit rating agencies like Moody's and so on and so forth, Morningstar, who typically rate assets and rate issuing organizations, which is great, but being able to augment that with maybe a more kind of sort of not crowdsource exactly, but a more sort of public approach to reputation is another thing which blockchains sort of at least unlock some of that potential.
Yeah, sure. So like with your background in like traditional finance, and I saw you have like a degree in computer science, like you could obviously go a lot of different directions. Like what made you want to work on Polymath and like in this area?
So it's a great question. So I graduated with a computer science degree, as you say, and I went to work at Morgan Stanley for the first 13 years, more or less. And that was a great experience, and I have no regrets. I learned a ton. I got to work in lots of different countries. I worked in New York and in Tokyo and so on. I guess my kind of journey into blockchain, so I think around 2016 or so, I got dragged along to an Ethereum meetup in London. So London has a great Ethereum community, some really kind of fun meetups and so on. So I got taken to this Ethereum meetup by a colleague who said, come along and have a look. And at that point, I'd heard of Bitcoin. I'd sort of, Bitcoin had been in the news. I'd sort of had a bit of a look at it, but never really dived in. So I went to this Ethereum meetup, and it was like a kind of eye-opening sort of experience, right? This idea of, what was really attractive as a developer is this idea of being able to build these kind of Turing-complete smart contracts, or more or less Turing-complete smart contracts on chain, which allows you to do all this, kind of almost anything, right? And have it locked down in this kind of public blockchain with transparent rules and so on and so forth, and kind of immutability. So that I left that meetup really like with my brain kind of pinging and exploding and feeling super excited about it. And within a few months, I'd quit my job. I was kind of consulting. I dived in sort of head first. Learned as much as I could. Absorbed as much of the technology as possible. Was kind of consulting, doing smart contract development and auditing for a whole bunch of the kind of with these kind of new blockchain organizations that were sort of springing up, companies like Aragon and so on. So I did that, and then in 2017 I met Trevor Kaverko, who's one of the founders of Polymath. And at that time, Polymath was really security tokens were like a brand new idea. Polymath was really kind of helping define the space, helping kind of explain why it was such an exciting thing. And for me, it was a great match. Right, I had my kind of institutional or traditional financial background from Morgan Stanley. I had this sort of passion, if you like, for kind of blockchain and decentralized technology. So Polymath for me, brought those two ideas together, and it's kind of it was like a super obvious, great match for me, and I haven't looked back since. So I started working with Polymath. I started as a kind of consultant, and then fairly rapidly became a full-time employee, and then have obviously my role has kind of grown as Polymath has grown over the last 2 years. Yeah.
So like you're head of blockchain now. So like you've transitioned from like an ERC20 platform, and like you came up with this ERC 720, I think it was.
ERC 1400.
1400, yeah. Sorry. ERC 1400 standard. Like, what's been driving your decisions like around the blockchain tooling and infrastructure that you build your platform on?
Yeah, so it's a great question. So we have, from when we launched in late 2017 up until today, we have been building on top of Ethereum. So, we have a protocol, we call it the ST20 protocol, which is, effectively a series of smart contracts built on top of the Ethereum blockchain. And that's been live now for more or less 2 years. And that's great. And we've seen great traction, adoption. It's given us, we have a number of companies that have come through and use the platform to issue securities, to issue dividends and do corporate governance and so on. And that's really, the experience has helped us really understand the space. It's grow our experience. And it's a new and emerging space, right? So it's not something... It's not like an established thing where you kind of have to come in and learn about it. It's something where you have to actively engage, right, and educate and learn from the kind of other ecosystem players. And we spend lots of time talking with all sorts of different stakeholders, from KYC providers to regulators to custodians to other companies in the space doing kind of similar stuff to ourselves. So we spent a lot of time learning and gaining experience and kind of understanding the space, and also understanding what requirements different entities have, right? So you have, let's say, very kind of crypto native type companies that very excited about novel technology, and then you have more like the kind of traditional incumbent institutions like the big banks and the bigger kind of trading houses who are more risk adverse and have like a different set of requirements. So building on Ethereum, that is rapidly build, rapidly iterate, and kind of understand the space a lot more. As part of that, as you say, we put together this security token standard, which is ERC 1400, which was, that was also a collaborative effort. We had this like workshop with 20 20 or so different companies that came. We spent several days discussing all the various different areas, and out of the back of that, we kind of came up with this standard. And the idea with the standard is that, much like ERC20 kind of drove this explosion of interoperable, protocols, things like DEXs, obviously companies issuing tokens, and now we see all these kind of DeFi type protocols like Compound and Dharma and so on. The idea with ERC 1400 was to do the same, but do it in a way that met the requirements for regulated securities, right? So utility tokens on ERC20 are great for utility tokens where there's no really regulatory kind of compliance. Anyone can hold them, anyone can send them. It's all obviously pseudo-anonymous. But for regulated securities, there's like a different set of requirements, right? You have to, typically they're not fully transferable. They may be locked up for some reason due to some kind of compliance rules. There are some kind of complex aspects to them. So the idea with the ERC 1400 was to have this sort of library of interoperable standards at different companies. So this, so it wasn't like a Polymath only initiative. It was an initiative that was kind of a community initiative, and we've seen lots of different companies building on top of ERC 1400, including companies like Consensus and various other kind of companies in the space. And what it should do is, the aim is to bring that same level of kind of interoperability that we saw with ERC20, but to regulated securities. So that was our kind of like Ethereum journey, and that's something we put. We're very close to the Ethereum community. We've sort of built this very kind of complex protocol. I guess one thing that came, some of the learnings that came out from that process is that whilst Ethereum is great, and I love Ethereum, there's a kind of, I guess there's like a saying, right, which is you can please some of the people all of the time, or all of the people some of the time. And Ethereum is this sort of general purpose blockchain. It's not optimized for any specific use case, right? So it's not optimized for gaming or for gambling or for security tokens or prediction markets. It's a general purpose platform. And that does mean that in our particular domain of regulated securities, there are some choices which are not optimal. And in particular, these are things like the proof of work consensus mechanism and the kind of permissionless mining process. So, one kind of concrete example, one issue that larger institutions have is that if you execute a transaction on Ethereum, you pay a gas fee to do that. That gas fee goes to the miner that happens to mine the particular block that includes your transaction. But that miner could be anywhere. It could be in the US, it could be in Europe, it could be in China, or it could be in a country where potentially there's some sort of sanctions. It could be North Korea, or some country where there are financial sanctions. And for a large institution, that's a huge issue, right? Because there's obviously, they're very risk adverse. They have huge kind of exposure to that type of risk. So there's certain kind of aspects of Ethereum which were non-optimal, which is why we started looking at alternatives. Yeah.
So I saw on your website, it's kind of leads to two questions. One is that you talk about white label solutions, and so were those kind of in that context of we need to make a special solution? Is that its own private Ethereum chain, or is that just some sort of other public chain solution that you would do for a white label?
So white labeling, so it's not a private blockchain solution. It is really taking our public protocol, which is there's a utility coin, Poly, which is what's used to kind of pay for services on this Ethereum protocol. It's taking that public protocol, and so we built sort of SDKs for that protocol, which makes it very easy for white labelers to build their own kind of front ends into that protocol. So the white labeling solution at Polymath is partly around that, so partly letting companies build their own front ends and brand them obviously appropriate to themselves. And there's also a kind of tokenomics aspect to white labeling. I don't have all the details in front of me, but broadly, if you're a white labeler and you're using the protocol in a kind of volume type way, there's a sort of like a staking type tokenomics where you sort of stake a certain amount of Poly, and then you kind of get a discount on protocol usage. So there's a sort of tokenomics aspect, and then also allowing people to effectively build their own front ends and with their own branding and workflow around the product.
Okay, and so the second question is the challenges of working on a decentralized protocol, but in a jurisdictional world. So how do you deal with this for different jurisdictions, and what are the main challenges to operating that way?
Yeah, so that's a great question. And definitely we have this mission, right, which is we want to be able to cover all jurisdictions and all assets, right, which is a mission. But obviously, there's a kind of concrete problem is that there's a zillion different jurisdictions. I guess hundreds of different jurisdictions and also dozens of different types of assets. So when you look at the kind of combination, that's an awful lot of complexity. So the way we've approached that, and this is true both in Ethereum and also in Polymesh, which is the new blockchain that we're building, is to have a highly modular approach. So like with the Ethereum protocol, there's a kind of core protocol, which is based around the security token and the kind of compliance and ERC 1400. But that protocol can then be extended using modules. So in different ways. So for example, we have one type of module which is related to compliance rules or transfer management. So so if you issue an asset in the US under Reg D, which is one way of fundraising in the US, it comes with certain types of compliance rules. So maybe the maximum number of investors in your asset may be capped. The maximum percentage that any individual investor can hold may be capped. There's probably some sort of whitelist. There's probably different rules for accredited investors and non-accredited investors and so on. So each of those compliance rules, rather than being kind of fixed in the protocol, is added via this module system. So you can kind of think of it almost like a kind of app store of functionality. So you have your core module with your ST20 token, and you can kind of pick and choose modules from this sort of module store and add them to your token to kind of fully build out the feature set that you need. And those modules can be built, and Polymath has authored and built a bunch of modules in that store. But if you're issuing an asset and we don't have the appropriate module, maybe you're issuing an asset in Ethiopia and there's some compliance rule which we haven't built in-house, you can kind of build that module and add it to your token so that the tokens, it helps to kind of future-proof them, and it also helps them to be extendable to as many asset classes as really, provided that you can represent that compliance rule in a smart contract in some way. There's no real barrier to the types of assets you can represent that way. So modularity helps a lot, right? It gives us that kind of flexibility. It lets us cover as many assets and jurisdictions as possible. And that's the same. So it's the same sort of ethos we brought to Polymesh, where you can kind of plug in these sort of smart extensions to your asset, which helps you extend the kind of base functionality. So that's that was one approach. Other than that, there's certainly like a lot of there's a lot of learning and understanding and engaging with regulators, understanding different regulators. We're focused a lot on Europe, Asia, and North America. So we engage with regulators in those areas and understanding their concerns and their kind of their sort of requirements is also important.
Yeah, so like in this sense, the actual token itself is like a very low-level abstraction, and then you use the modules to construct the logic of how these tokens are allowed to be transferred.
That's exactly right. And so modules kind of come in different categories. So compliance rules is one category. Sort of funding or fundraising rather is another category. So if you're fundraising, different people want to fundraise in different ways. Maybe you want to have a tier structure. Maybe you want to have a private fundraise. Maybe you want to have a public fundraise. Obviously, depending on the asset and the jurisdiction. So that's another category. We also do. There's a category of modules around kind of capital distribution, so things like dividends and payments for structured products and coupon payments for bonds and so on. So that's like another category of modules. And in all of these categories, we have, I guess, like the biggest use cases we tend to have modules authored in-house for, but certainly you can bring your own modules into the protocol as well.
Yeah. So talking about like the actual architecture of this thing, you're going off of Ethereum and you're creating this Polymesh. Can you talk about like how this is different from the Ethereum solution and just an overview of Polymesh?
Yeah, absolutely. Yeah. So Polymesh, so there are a few key aspects to Polymesh. And the way I think about it is kind of in two categories. You have the kind of the sort of enabling layer, which is things like the kind of consensus mechanism and things of that nature. And then you have the enabled layer, which is more like the kind of business logic around it. So we start with the kind of low level first. So Polymesh is built on top of the Substrate framework, the Parity Substrate framework, which is a framework which enables organizations to build new sovereign blockchains. And it's like a modular framework. It takes care of lots of the kind of low-level networking and things like that for you so that you can kind of focus just on the components that you want to focus on. So in the case of Polymesh, there's a few key aspects to the blockchain. One is that it's a proof-of-stake blockchain, and the block authors or the validating nodes are permissioned. So, as I mentioned, obviously in Ethereum and in lots of other blockchains, miners or validators or block producers are permissionless, which means you don't really know where they are, and that can obviously cause problems. In Polymesh, we have permission validators with that permissioning managed through on-chain governance, which gives users of the chain confidence that the people, if you like, progressing the chain and producing blocks are either regulated or reputable organizations in jurisdictions which are, let's say, well understood and have kind of clear frameworks.
Yeah, who do you imagine to be these validators?
I don't think there's like a one size fits all. I think, ideally, so I can talk about maybe what the ideal validator might look like, right? Which is probably a regulated institution of some sort. So that's maybe a broker-dealer or a bank or a KYC organization or a custodian, those types of organizations. Obviously, there is a technical, experience needed to run a node because you have to run a node, you have to have infrastructure to do that. Obviously, running a node on these proof-of-stake networks, if your node misbehaves, either due to malfeasance or an accident, then there are potentially some penalties involved, these sort of slashing rules that help incentivize correct behavior on the network. So there's certain technical expertise that's probably required to do this. We would like validators to be not just in one jurisdiction, right, but to be spread across different jurisdictions. So those are the sorts of companies we're aiming at. But I think the key point is they should be reputable organizations, so organizations with a known public identity based in reputable jurisdictions. So obviously that excludes certain like OFAC sanctioned countries and so on, and with the technical kind of competency, obviously, to run these nodes. Although we are seeing lots of infrastructure as a service companies coming into the space. So that's another, maybe if a company doesn't have in-house the technical expertise to do it, there are increasingly more service providers able to offer that.
Yeah, sure. So you're continuing about the architecture, like after consensus.
Yes.
What comes next?
So consensus is important, right? So it's sort of permission consensus. There are some other aspects. So we use this kind of grandpa finality. One big advantage that has is that so on a proof of work network like Ethereum, you have this kind of statistical or probabilistic concept of finality where, depending how deeply a block is buried in the chain or a transaction is buried in the chain, you have this sort of increasingly probabilistic idea that it's unlikely to be reverted. With the proof of stake network using a kind of BFT type technique, you get absolute finality, right? So when a block is finalized, it's finalized. So, there have been proof of work chains. So I think Ethereum Classic is a good example, right, where we saw, I think a few months ago, right, there was a 1 or 2 day block reorganization with Ethereum Classic. And Ethereum Classic, I'm not saying this, that's one specific example. And what that means for users, if you're a bank or you're a large institution and you're relying on these chains for settlement, it really means you have to wait 2 days for settlement, right? And I think exchanges now, I don't know all the details, but I think for Ethereum Classic, you probably have quite long waiting times when you're depositing to an exchange for that reason, right?
Which completely kind of violates the whole stated advantage of blockchain about don't settle in T+3, settle day of or something.
Exactly.
You can't trust that then.
Yeah, so that's exactly right. So you have one of the, as you say, one of the big advantages, one of the big selling points should be this near instantaneous settlement, right? But you don't. I say certainly on proof of work networks that becomes more questionable. You're also sort of at the mercy of the markets, right? Because obviously the probability, or the cost of a block reorganization depends on the hashing power behind it, and this slightly murky world of miners and ASICs and hash power and all this sort of stuff, which can be hard. That risk is very hard to manage if you're a large institution, and frankly, you may choose just not to manage it, which means you don't kind of go near those blockchains. So that's one important aspect. Another kind of key point is around governance and forks. So if you take Ethereum as a good example, right? So Ethereum has a sort of off-chain decentralized governance approach, which is great. So I have a huge amount of respect for the people working on Ethereum, and it's they're choosing to go this tough route, right, with being general purpose, of being decentralized. But what it does mean is that forks can be messy, right? You can have a contentious fork. We've obviously have some examples of that in the past. You can have a contentious fork and you end up with two blockchains effectively, right? Your blockchain forks and both sides of the fork maybe remain viable. And there's been some advice from one of the big four accounting firms that if you're using a public blockchain like Ethereum, you should, as an organization or as an institution, you should have a working group whose only purpose is to manage that type of instant, if you like, because obviously, if you've issued an asset on, say, something like Ethereum and Ethereum forks, suddenly you have kind of 2 copies of that asset, right? One on each side of the fork. And if you've tokenized a building, for example, it's not like the building suddenly replicates itself. Right? It'd be nice if that was the case, but obviously that's not the case. And for base cryptocurrencies, that's not such a bad thing. Like you end up with ETC and ETH, and that's fine. They can have different market values, but with real world assets, that doesn't really apply. So governance and forks and roadmaps and so on can be tricky in these types of blockchains where there's sort of very decentralized approach. Substrate or Polymesh built on Substrate helps with a lot of those problems, right? So you have this sort of so-called forkless network upgrades or forkless forks or something where, because the state transition function is itself under consensus as a WASM blob on the blockchain, all the kind of participants, if you like, all the observers of the blockchain have a very clear idea of what the sort of official blockchain is, if that makes sense.
Yeah, the official state transition logic.
Yeah.
Yeah. Okay, so when it comes to Polymesh, who are the users? Do you see normal people who want to trade these securities being the users, or is this more of just a framework for an institution who wants to issue securities to issue them with?
So it's really, I think it's a 2-sided market broadly, maybe a 3-sided market, right? So you have asset issuers, so people who own assets who want to tokenize them. So maybe you own a company and you want to tokenize it, i.e. issue equity, or maybe you own as you say, maybe a painting or something like that. So some other sort of security, or a real estate fund that you want to tokenize. So you have asset issuers. The other side of the market is investors. So investors obviously from different jurisdictions, and different jurisdictions obviously define investors as in different ways. You have accredited, you have non-accredited, you have sophisticated or qualified, and so on. So you have investors who want to invest in these types of assets or have portfolios or groups or baskets of these assets. And then really the third category, which is equally important, is, so I think of them as service providers. So these are people like KYC firms, so firms that execute KYC and anti-money laundering and source of wealth checks on individuals, both on issuers and on investors. Other service providers are custodians, which is super important, right? Custodianship of kind of crypto assets is one of the key questions raised by regulators all over the world, right? Having a kind of reliable, trusted set of custodians is really important. We've seen, obviously in the blockchain space, lots of assets be lost, often irreversibly lost, right? Because mistakes have been made. So working out how you can have professional organizations that can kind of come in, maybe insure that risk or have great governance around that type of risk is really important. So KYC, custodians, exchanges obviously are important, right? Having regulated or licensed trading venues for these types of products is important in different jurisdictions. And there are some other kind of, say, ecosystem or service providers in there as well. So I sort of see it as that sort of 3-sided marketplace. Issuers, investors, and service providers are all key stakeholders.
Yeah, and the way they interact, what kind of what would you think is interesting and something they could do together? What would be a cool application of Polymath that you would like to see?
So that's a great question. I mean, I can say some of the things that I'm most excited about in the future, right? So some of this is a little bit forward looking. So I think so at the start I sort of mentioned DeFi or DeFi or open finance, which is, so on Ethereum in particular, we've seen all these really interesting protocols like Compound, these sort of lending protocols where typically you have these kind of over collateralized products and you can borrow and lend different types of assets. There are other protocols. There's a protocol called SET, which allows you to basically create baskets of different assets, all in a trustless, non-custodial way. There's DYDX, which lets you take, let's say, derivative positions or leverage positions and so on. So you have all these kind of very cool DeFi protocols. At the moment, they're quite constrained. And I think they're constrained for 2 reasons. The first reason is that they tend to only deal with sort of base currencies and utility tokens. So typically Ether and maybe some utility tokens. So I think MakerDAO have recently introduced BAT, which is a utility token. But usually what you're borrowing and lending and using as collateral are these either base assets like ETH or these utility tokens. And something that security tokens can bring on Polymesh and on Polymath is you have this huge $1 trillion regulated securities market globally, right? If you can bring those assets into DeFi, for me that's like DeFi times 100 or something, right? Because you have all these kind of interesting, varied asset classes, and you can start to use those as collateral, right? So rather than having to use Ether as collateral, you can take your Apple shares, your Tesla shares, or whatever, right? Or some basket of shares and use those as collateral. So that's one exciting thing, which I think will happen. These things take time, and because it's regulated, obviously the progress can be a little bit slower, but I think that's one thing that will happen. The other issue that DeFi has is around Sybil prevention, right? So one of the reasons that typically all these protocols rely on over-collateralization is that if on the blockchain I lend you $100, there's not much that stops you running away with that $100, right? So to prevent that, I usually ask you to put down $150 of collateral, so that if you do run away with the $100, then I have sufficient collateral to kind of back that, and that makes sense. And the reason why that's the case is obviously these blockchains are all pseudo-anonymous. There's very little Sybil protection, right? So you can create thousands of accounts at very little cost, and sort of from the perspective of a protocol, it's very hard to tell if it's the same person or different people interacting with it. So one thing Polymesh brings is we have kind of KYC and identity as a sort of base layer construct in Polymesh, so that as these DeFi protocols innovate and grow, we hope that will open the kind of design space for what types of DeFi protocol are possible, because you do have some, it may not be perfect, right, but you have some measure of Sybil protection. You have identity and kind of KYC and all these concepts baked in at the base layer, so you can start to have protocols that rely on them. And I think for me, that's one thing that's likely to open up the space dramatically.
Yeah, I think that'll be interesting as like interoperability develops. Is like, yeah, it would be cool if instead of using like Ether to back your loan, if you could like tokenize your car and use that to back something else.
Absolutely, yeah.
Also, like this kind of goes back to the whole like proof of ownership, or like how do you, like there has to be some asset that's actually backing this. But I'd be interested to see like rules for actual transfer of this, right? So like if you tokenize like your painting, and then there should be like some rule that says like if somebody accumulates more than like 40% of the tokens, then they have the right to like actually take the painting and put it in their house or something. Like,
yeah, I mean, so definitely, so another area that I'm really excited about. We're starting to see again the kind of green shoots of this are these like more complex types of products, right? So because you can, the beauty of smart contracts and the beauty of the kind of blockchain technology, right, is you can start to build some quite cool, quite complex behavior. So one simple example would be something like the SET protocol, where you have a basket of assets and the performance of the basket is a sort of like a blended performance of all the underlying assets. But you can imagine let's say you take a painting example, right? So there's a painting, maybe someone tokenizes a painting, and they take that painting and they lend it out to a museum, right? And the museum pays some revenue stream back to, maybe they pay whatever $100 a day or whatever it is, and that those $100 are taken and distributed out to the owners of that asset, the kind of tokenized owners of that asset. And then you can imagine, kind of doing sort of derivatives of that, where you maybe take different types of things and you kind of blend the cash flows, you put them together and you pull them apart. And there's some interesting companies working on that type of thing, right? So you can have these synthetic products or structured products, and structured products have a little bit of a bad name because in the traditional financial world, people think of things like credit default swaps and some of the things that caused problems during the 2008, 2009 kind of credit crunch. But one of the issues there was the opaqueness of the products, right? So you had these baskets of bonds or mortgages or whatever, right? And it was super untransparent what the underlying products were. The nice thing about blockchain technology is you can do the same thing, but be fully transparent, right? So people can really see everything that's happening under the covers, right? You don't have to just rely on a bank and a credit rating agency to kind of give you some idea what the product is. You can do your own due diligence, and of course, maybe that requires a certain skill set. But in the community, people can do this and kind of understand it much the same way. With smart contracts, of course, not everybody can read a smart contract and understand it, but if like the community in some sense can kind of do some due diligence or auditing around the logic in a smart contract, and you can kind of get a feel for, well, is it a safe smart contract? Is it a dodgy smart contract, or what the kind of risk factors are?
Yeah, I think the transparency and verifiability are really big, because I think people tend to they lump all these problems into one thing and they just say, okay, the bank is bad. Like, that's it. And just end of story. And it's like, well, actually, no, like the bank is doing something really useful. It's collecting assets that are completely disparate and finding a better way to allocate them. That's actually a useful thing. The problem is that it's untransparent and unaccountable. And so like when it comes to verifying things, when you can put it in a formal protocol like a blockchain, it just completely takes that load off of a human being to do that. And like it actually like targets the problem, which is not like the entire institution, it's the transparency.
So, 100% agree. And I think, as you say, it's a lot about trust as well, right? So, if you want to buy one of these structured products from a bank, you kind of have to trust the bank. You have to trust the credit rating agency to have done the due diligence and to be, for them maybe not to have any sort of side incentive, for them, because one of the issues with banking is often the incentives are a little bit misaligned, right? The bank is maybe making money by selling you the product, but of course, then they want to sell you the product and they may not be quite so incentivized to give you fully transparent information around that product and so on. And obviously there's rules and regulations that try to address that, but you can have this like misalignment of incentives. And one of the nice things that blockchain does is it kind of commoditizes that trust, right? It removes this requirement to trust a single centralized party, whether it's a bank or a credit rating agency, and instead lets you, provided you trust the blockchain or the technology, let's say, or the code, or the protocol, you no longer have that requirement for these sort of central actors to be those sort of centers of trust, which in the banking world is a big issue. Right? I mean, trust is not everybody has trust those types of actors.
Right. If we can get the bank to focus on identifying the best ways to redistribute assets and let the trust just be like inherent in the protocol, it removes a huge point of friction.
Absolutely. And in banks, so we spend a lot of time talking to the banks. To say, obviously, my background is there. And banks are super excited about this type of technology. Of course, they're risk adverse and they're a little bit conservative, right? But they're pretty much every large financial institution is thinking about, is investing in this type of technology, is trying to understand what the future looks like, is doing that analysis. So banks are super excited about it as well. And for them, that it brings them a whole bunch of advantages, certainly like around things like settlement, operational costs, reporting, reconciliation, all these sort of things. Blockchains solve a lot of those problems. So, and as we've seen, right, lots of banks are experimenting in the area. Maybe they're dipping their toes and taking small steps, but certainly, for those guys as well, it brings a whole bunch of advantages.
So one part I wanted to go back to that we were talking about, we've talked a lot about like these modules, like an identity module and stuff like this. And we've also talked a lot about smart contracts. And in the like architecture of your chain, how do these things work together? Because this is something that we talk about quite a lot at Parity is like modules are very good for some things and smart contracts are very good for other things. And people tend to look at them as like completely separate, like this is a smart contract chain and this is like a runtime chain. But I think there's actually like a lot of ways that like runtime modules and smart contracts can work together. They just each have like special logic. And so like, how do you view that like as you build your chain?
Yeah, so I love that. And it's one of the areas. So when we first decided to start doing research around Polymesh, it's one of the, we looked obviously a whole bunch of different frameworks, a whole bunch of different approaches. One of the things that attracted us to Substrate, to Parity Substrate, was that the Parity team were working on both sides, right? So they're working on having these runtime modules, which I think was being like kind of base layer or layer one sort of objects or constructs, as well as having smart contracts, which is more like a sort of dynamic system where you can dynamically deploy new smart contracts. I think the key thing, as you say, is that for us, the most exciting use cases for smart contracts are where those smart contracts can have kind of rich interactions with the underlying runtime module. So let's say you take something like identity, right? So in Polymesh, identity is a runtime module. We have this, let's say standardized, kind of sophisticated way of managing identity and key management and claims and attestations. That's a runtime module. So that's sort of basic to the chain, or it's a base part of the base layer of the chain. But we also want, we want people to be able to deploy smart contracts, maybe to build some sort of DeFi protocol or to extend the behavior of an asset or something. And those smart contracts need to also be able to read and potentially push data to those identity modules, right? Because you want the smart contract to be able to understand, is the person using the smart contract, are they an accredited investor? Do they have a KYC check? Do they have whatever other identity characteristics needed? So having this kind of rich interactions between runtime modules and smart contracts, I think is one of the most exciting aspects of something like Substrate. And it's an area, so something we thought about pretty early. It's something we're working with the Parity team. We have kind of technical engagement with the Parity team, which has been going for a few weeks now, to help extend that functionality. So there was some very kind of basic ways for smart contracts and runtime modules to interact. But we were really interested and excited by enriching that experience, and that's something we've been working with Parity on for a few weeks, and we'll continue to work on. And all of that code, it's worth saying, is not in any sense owned by Polymath. That's all code that will go back to the main Parity Substrate master branch or version 2 or wherever it ends up. And we hope and expect that not just in our domain is regulated securities, but there's obviously a whole bunch of different companies working on Substrate. We kind of hope and expect that functionality will be useful in a whole bunch of different use cases. Whether it's Edgeware or any of these other kind of companies are looking at smart contracts and how they can be used. And you're right. I think there's this sort of interesting idea that at the moment you either have a smart contract chain or a runtime module chain, but actually I think the most exciting thing is where you have both and they kind of complement each other.
Yeah, like the runtime modules are really good for if you have if you know the bounds of your logic. Like I just want to add this person to an identity database. That's very simple. Whereas a smart contract is if you don't really know how long it's going to be. So if you want to compare, oh, well, somebody made a transaction, I have to compare against this list, but I don't know how long it's going to be. It's that's a nice place to use some gas metering or something to limit it.
Yeah, so that's definitely one aspect. The other aspect, so again, right, so for Polymesh, we know that, so we want anyone to be able to use network. We know that there's a whole bunch of asset classes and jurisdictions out there where maybe legislation is still evolving, right? So we don't know all the compliance rules. We want people to be able to, every time we support a new asset, we don't want that to involve having to upgrade the entire network, right? So being able to, nice thing about smart contracts, that they can obviously be deployed dynamically in a more or less sort of permissionless setting, right? So being able to kind of extend our basic functionality in ways using smart contracts is something which is great for us, right? So it means we don't have to anticipate every possible type of asset. Very similar to our modules on our Ethereum protocol. We expect people to be able to build compliance rules as smart contracts, deploy them, attach them to their asset, and they're good to go, right? And they can do that without Polymath having to upgrade the whole network.
Is there anything else you want to add before we wrap up? What's your progress like as far as?
So I can definitely talk a bit about that. So where we've got to date. So we spent the first few months building a proof of concept in Substrate, which we completed around 6 weeks ago, I think, or a couple of months ago. And we're now very focused on version 1 of Polymesh. Our timeline for version 1 is Q2 testnet. So that's Q2 2020 testnet and Q4 2020 for the mainnet. So that's, we're super focused on doing that. We recently, so a couple of weeks ago, we open sourced our code base. So we had been working in a kind of semi-stealth private way. Our code base is now fully open source. You can find it if you Google Polymath Network GitHub, you'll find it.
Yeah, we can put a link to it in the notes.
Great. So it's out there, and so I'd encourage. We've already seen a bunch of developers putting some PRs in, taking a look at the code. Obviously, for us, that's great. It's amazing to see that kind of community involvement. One of the reasons why I'm so excited to be building Polymesh on Substrate is that Substrate comes with the community, right? So obviously it's a Parity written framework, but there's a whole bunch of different teams. It's kind of like a whole community around it, right? Building tooling, working on the framework. Our experience in Ethereum was that the community is so important, right? If you don't want to work in a vacuum, you want to be able to learn from other people in the space, whether they're competitors, whether they're doing completely different things. There's always a ton to learn, right, from other people. And we saw that in Ethereum. We're really excited to kind of engage with the community on the Substrate side. So our code base is open source. If you're a developer, come and take a look. All of the runtime modules that we kind of talked about and a bunch more are all out there. Obviously, it's a fast evolving code base because it's we're in that kind of heavy build stage. But we'd love any feedback and thoughts on it.
Yeah, and where else would people look for information, like your website?
Yep, so we have polymath.network is our kind of main website, and that links out to, so we started blogging about a bunch of different things in the space around our work on Substrate, and we will kind of continue to do that, and maybe some of the challenges, some of the difficulties, some of the solutions, all those sort of fun things. So you can find our blog on polymath.network, say GitHub. We also have a Telegram and various other Gitter channels and so on, but that's all linked to from our website.
All right, great. Thanks for coming on, Adam.
Great. Thank you very much for having me.
Thanks for listening to Relay Chain. We'd love to keep in touch. Follow us on Twitter at RelayChain or email podcast@parity.io. Our team at Parity includes some of the leading peer-to-peer networking developers, consensus algorithm inventors, blockchain innovators, and Rust developers. If you want to learn more about our work or want to work with us, visit our website at parity.io and sign up for our newsletter at parity.io